Hi, everyone, and welcome to the Buffalo and Beyond Saturday ETF Report, May 18, 2024. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week, we're going over the top stocks in the QQQs, that's the NASDAQ 100, and the hedging aspects of it, and hedging the home builders. Yes, we have a triple inverse ETF for the home builders. Okay, here we go. All right, let's look at the QQQs. Nice rally up, and then we had that decline a couple of weeks ago, and now we're rallying, and we are sitting at new highs and testing those new highs. And we'll see where that goes next week, folks. And with the XHB, which is the home builders ETF, same thing. However, we did not reach new highs, and that has us just a bit worried, and it all depends on what the Federal Reserve does or says during this time period over the next couple of weeks. So we'll see what happens, because don't forget, the home builders are a good ETF. And in fact, let's take a look at them. Now here we are, the XHB, which is the home builders, QQQs, the NASDAQ 100, versus the S&P 500 over 5 years. Black line is the S&P 500. You see, because our whole business is picking the best stocks in any index or ETF, and if we can pick the above average stocks and forget about the below average stocks, we should be able to outperform every ETF and every index that's out there. And boy, we do a pretty good job at it. But let's take the best ETFs and the best stocks in those ETFs, and that will add insurance to us that we do outperform. So again, black line is the S&P 500 over 5 years, blue line the QQQs, and the XHB, which is the housing, is even outperforming the QQQs. Now don't forget, the QQQs have what? Semiconductors in it, and they have the technology stocks in it. But I want to show you something. First, also, I want to show you this. This is 2002, where the market was just down almost 20%. I'm talking about the S&P. The NASDAQ was down 34%. So we want to be able to take a period such as this and at least protect against it, or at least some of that decline in there. So that's what we're all about. Picking the best stocks and the best ETFs, and then being able to hedge them. So let's go here. I want to show you the technology ETF, because technology ETF last year just rocked and rolled. And what's it doing this year? Just about nothing. With the S&P up about 11%, the XLK, which is a technology ETF that we use, up 10.3%, and the top stocks that we picked up 10.5%. So you can see that the technology ETF is not working. There are some stocks in here that work very, very well, and it worked very, very well last year. But right now, most of the ETFs are not working very well at all. Let's go to the semiconductor ETF, up just 6.1% this year. The S&P up 11.1% this year. Our top stocks are up 21%. However, if you take NVIDIA out of this mix here, then we're up only about 6 or 7%. We're up the same as the semiconductor. Now, I have no doubt that by the end of the year, we will certainly outperform, but we want to outperform by a lot. We don't want to outperform by a little. So how do we do that? Well, let's go to the QQQs and the top stocks in the QQQs. And now we hedge with an inverse 3-to-1 inverse ETF, which is the SQQQs. In other words, you're short 3-for-1, the QQQs. So we want to put that in there, and we have two scenarios. One where we're hedged all the time, about 30%, and the second one is where we're hedged 30%, but we time that hedging. And timing, as you know, it's hard to pick the bottoms, hard to pick the tops, and you try to get that piece in the middle where you have a trend either one way or the other. So we've got our top stocks, and guess what? Our top stocks are up 21.2%. Now, if we're fully hedged, just fully hedged all the time, we're doing 11.3%, which is a tad bit more than the S&P 500 and a little bit more than the QQQs themselves. But this is being fully hedged. I shouldn't say fully hedged, 30% hedged all the time. When I say fully, I mean all the time. So we're still up as much as those other ETFs, and I'm talking about the S&P and the QQQs. We're up as much as them, but we're hedged 30% all the time, so we avoid those nasty downdrafts. Now, if we time the hedges, we're doing almost as well as just being long the top stocks. So if we time it good so that we get, let's go back to this a minute. So if we time it so that we can stay away from a good part of this downdraft in here, then we're really going to be able to outperform. So just think if we came down just 1/3 as far as we did, or even half as much as we did, and then we started the rally from here, we'd be up all the way over here already. So that's what we're trying to do, and that's how you build serious wealth over the years. Now let's go to the home builders, and the home builders up 11.9%, S&P up 11.1%, but the top stocks in the home builders that we picked for this year up 19.8%. Now, if we are fully hedged 30%, so fully hedged again means all the time that we're hedged 30%. So we put the hedges on, we go to the beach for a year, and we don't come back until the next year. We're actually up more than just buying the long stocks. Now, how did that happen? And I don't have numbers for the timing yet because that's what we're working on as we speak. So we look at the XHB, in other words, the housing ETF versus the DRV, which is the triple inverse of the XHB. So you see that this is the housing, the building of the homes, HB, DRV, driving those nails. And I got one more for you, folks, so hold on. But anyway, we want to get into something that's inverse, 3-to-1, so we don't need to use as much money. So we have the HXB, and here's the triple. So this yellow line should be tripling the black line. So here's the black line as was on a roll up, and the tripling of the DRV eventually went down, which it's supposed to do. Then when the HXB started going down, the inverse ETF went up. So there's your hedging in there. And now as the HXB starts going up, this will start coming down. So that's how that works. But I know you have to think a little bit because this is 3 times this, but let's put it on the same scale. So let's go to triple the XHB. And what is the symbol for the triple? In other words, bullish by 3 times. So triple, whatever the housing index does, this black line does it triple. And of course, the yellow line is the inverse, so it triples the other way. And now they're on the same scale, so you get a better look. So as this goes up, this goes down. As this goes down, this goes up. So if we put 30% of our portfolio hedged, that means we can actually put more money into the ETF itself. So we just want something that works opposite our ETF and does it triple, so we only have to put 1/3 the money in order to hedge. And what is the symbol of the triple bullish housing? Yeah, it's nail. That's why I'm laughing, folks. Who comes up with this stuff? So you have the nail, that's the triple bullish. You have the DRV for driving those nails, which is the bearish, and these are triple. But I just wanted to show you we need something that moves opposite our long positions. So folks, we had a great week this week as the market, and talking about the Dow, went to the 40,000 level, went above it, couldn't hold it on Thursday, and I'm recording this about an hour before the market closes on Friday. Doesn't look like it's going to do it today either. So next week is going to, or this coming week is going to be a very, very exciting week in here. That's why we have a few clouds in the rising of the sun over here, because next week or this coming week is going to be very, very interesting indeed. So folks, you go out, clear your heads. You're making money in these portfolios no matter what you're doing with them. And our top stock stocks are just performing wonderfully. We're doing great. So you go out, clear your heads, have a great weekend, be with your family, stay safe. So folks, we'll be back in just a few days. See you then.